Welcome to The Explainer. We're going to jump right in today because we're talking about a huge shift in retirement savings, one that could affect, get this, nearly 90 million Americans.
$3 trillion. I mean, just let that sink in for a second. That's the size of this massive, and I mean fast-growing, financial market that until now was pretty much completely off limits to regular folks like you and me.
And now, well, that $3 trillion force is knocking on the door of your 401k. So, are you ready? Let's break down what this really means for your money. Okay, so first things first, what in the world is private credit? You might have heard it called shadow banking, and yeah, there's a pretty good reason for that. Okay, think of it like this. It's lending that happens in the shadows, away from the big, highly regulated banks we all know. We're talking about direct, custom-made loans from huge private equity firms to companies that a normal bank might turn away. Maybe they're seen as a little too risky, or they're too small, or their situation is just complicated. It could be anything from a medium-sized tech company trying to grow to a big-name store that's trying to pull off a comeback. And this chart, this really lays it all out. After the 2008 financial crisis, everything changed. Banks got super cautious because of all the new rules. So you've got traditional bank lending on one side, highly regulated, and on the other, private credit. It's a lot less regulated, a lot more opaque. And that created a huge opening. Private credit jumped in to fill that gap, lending to all sorts of companies that suddenly couldn't get a loan anywhere else. So you gotta understand, for a long, long time, this was a playground for the big guys, huge institutions, the ultra-wealthy. So the big question is, how on earth did it suddenly get a backstage pass to your retirement plan? Let's look at the timeline, because it happened fast. The floodgates, they really blew open in August of 2025. I mean, it was bam, 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 one thing after another. It started with an executive order. Then, almost right away, the Department of Labor did a complete 180 on its old, cautious advice. And then the SEC jumped in, getting rid of a key limit on these kinds of private investments. It was like they coordinated to roll out the red carpet and say, come on in to the 401k world. Okay, so you might be asking, why? Why let this stuff into our retirement plans? What's the upside? Well, it all boils down to one very powerful, very tempting word, yield. And wow, this chart just says it all, doesn't it? Look at that difference. Private credit yields, they can literally be double what you'd get from a typical high-yield bond. And let's be honest, when you're trying to grow your retirement savings, that is hard to ignore. But it's not just about chasing those big returns. The argument goes deeper. Proponents say it helps you diversify, not having all your eggs in the stock market basket. And there's this other big idea. Finally giving regular savers the same tools that the super rich and big pension funds have been using for ages. And that really gets to the core of the argument. It's all framed as an issue of fairness. The idea is to level the playing field. I mean, why should only a select few get access to these kinds of returns? Especially when you've got 90 million Americans with a median 401k balance of around 88 grand trying to build a future. Okay, so that's the promise. Sounds pretty good, right? But there's always a but. On the flip side, critics are sounding some major alarm bells. They're saying these rewards come with some really serious and maybe not so obvious risks. So, what are we really talking about here? Let's look at the big ones. First up, fees. And these aren't small. We're often talking a 2% management fee plus a 20% cut of the profits. That can take a huge bite out of your earnings. Then there's illiquidity. That's a fancy word that just means your money is locked up for years. We're talking 5, maybe even 10 years. You can't just cash out if you need the money. And then there's the opacity. How much is this stuff actually worth? Unlike a stock, there's no daily price ticker. The value is basically what the manager says it is. And finally, this stuff is just plain complicated. It's not easy for a non-expert to wrap their head around. And that complexity, it has some experts seriously spooked. They're warning that for the average person who isn't a Wall Street pro, the potential for things to go wrong is huge. I mean, one expert even said a major loss here could be Enron-level catastrophic. That's a big statement. So what about that whole idea of investing like the smart money? Getting access to what the big pension funds use? Well, the data tells a more complicated story. In fact, one analysis found that over the last decade, a bunch of top U.S. pensions, the ones using all these fancy private assets, actually made less money than a simple, kind of boring 60-40 stock and bond portfolio. Kind of makes you think, right? But this isn't just about what might happen to your individual 401k. there's a much bigger concern here. See, this so-called shadow market, it isn't operating in a vacuum. It's connected to our everyday banking system to the tune of over $300 billion. And that is what keeps regulators up at night. They call it systemic risk. It's the fear that a big problem in private credit won't stay in private credit. It could trigger a domino effect, a cascade that could threaten the whole economy. Think back to 2008. The worry is that we could see a sequel, but this time it's starring a part of the financial world with way fewer rules.
Okay, so we've got this huge potential upside on one hand and some pretty scary risks on the other. So where does that leave us? What does all this actually mean for your money, for your retirement?
You know, at the end of the day, it's a classic financial tug-of-war, innovation versus protection. The promise of bigger returns and democratizing wealth pulling one way, and the very real risks of high fees, confusing products, and savers getting hurt pulling the other. And believe me, there is no simple right answer here. So what does that mean for you? It means you've got to be your own advocate. You have to be proactive. When, and it's probably a when, not an if, these options show up in your plan, you need to be ready to ask some tough questions. Like, how much risk am I really okay with? What are the actual fees here, down to the decimal point? Is this just a tiny little sprinkle in my portfolio, or is it something more? And maybe most importantly, should I talk to a pro about this? So ultimately, as this multi-trillion-dollar market steps out of the shadows and into your 401k, we're left with a huge question. Is this truly the democratization of wealth, giving everyone a fair shot at bigger returns? Or is it the socialization of risk, spreading the danger of a massive blow-up across the retirement accounts of millions of everyday Americans? The answer to that, well, it's going to define the future of retirement for a generation.